At the end of the 20th century, Argentina looked like proof that economic redemption was possible. A country once crushed by hyperinflation, political chaos, and international isolation had apparently found the secret formula. Prices were stable, the currency was strong, supermarkets were full. Foreign investors were lining up. Argentines traveled abroad with confidence, flashing a peso that was as good as a dollar. And yet, just a few years later, that same nation would watch its banks shut their doors, its savings evaporate, its currency collapse, and its presidents fall one after another in rapid succession. How did a country that seemed to have done everything right end up detonating one of the most dramatic economic collapses in modern history? And more unsettling still, if Argentina followed the rules and still failed, what does that say about the system itself? To understand the Argentine collapse of the early 2000s, we need to rewind to a time when the country was fighting a different demon altogether. During the late 1980s, Argentina was trapped in a nightmare of hyperinflation so severe that prices could double in weeks, sometimes days. Workers were paid and rushed immediately to stores before their wages lost value. Savings became meaningless. Trust in money itself disintegrated. By the time Carlos Menem assumed the presidency at the start of the 1990s, inflation was not just high, it was existential. The state could not plan, businesses could not invest, and citizens could not think beyond tomorrow. The first priority was not growth or fairness or long-term resilience. It was survival. That urgency gave birth to a radical solution known as the convertibility plan. Under the guidance of Economy Minister Domingo Cavallo, Argentina made a bold promise to the world and to its own citizens. 1 peso would equal 1 United States dollar. Always. Not approximately. Not loosely. Exactly. The central bank was legally bound to hold $1 in reserves for every peso it issued. In theory, this stripped politicians of the ability to print money recklessly. In practice, it was meant to import credibility from the United States monetary system itself. Inflation collapsed almost overnight. Prices stabilized. Confidence returned. For ordinary Argentines, the change felt miraculous. After years of chaos, money finally meant something again. The global financial community applauded. Argentina became a star pupil of market reforms. State companies were privatized. Trade barriers were lowered. Capital flowed in. The peso's strength made imported goods cheap, raising living standards quickly. Buenos Aires felt like a first-world city reborn. Cafes filled. Construction boomed. Credit expanded. And for a time, it worked so well that it seemed almost offensive to question it. But beneath the calm surface, a dangerous imbalance was forming, quietly and relentlessly. A currency fixed at 1-to-1 with the dollar sounds stable, but it carries a hidden cost. When the dollar strengthens globally, the peso strengthens with it, whether Argentina's economy can handle it or not. As the 1990s progressed, the United States dollar rose in value, especially after crises in Asia and Russia sent investors fleeing to safety. Argentina's peso rose too, making its exports more expensive and less competitive. Local industries struggled. Manufacturing jobs disappeared. The economy began relying heavily on imports while exporting less and less. Growth slowed, then stalled, but the currency could not adjust. Devaluation, the traditional pressure valve, was forbidden by law. At the same time, Argentina's government continued spending as if growth would return on its own. Tax revenues fell with the slowing economy, but expenses did not. To bridge the gap, the state borrowed. At first, borrowing felt painless. International lenders trusted Argentina because of the currency peg and its reputation as a reform success story. Dollars were available, and the interest rates, while higher than those paid by wealthy nations, seemed manageable. Debt accumulated gradually, then faster still. What began as a temporary solution hardened into structural dependence. As years passed, the economy slipped deeper into recession. Unemployment rose, poverty increased, small businesses closed. Yet the peso remained strong. suffocating any chance of export-led recovery. The government responded not by abandoning the peg, but by doubling down. Each new loan was framed as a bridge to renewed confidence. Each austerity measure was promised as the last painful step before recovery. But the more the government cut spending, the more the economy contracted, shrinking the tax base and making the debt even harder to service. Cause fed effect, and effect fed cause, in a tightening spiral. By the end of the 1990s, the cracks were impossible to ignore. Investors began to ask an uncomfortable question. How would Argentina ever repay its debts if it could not grow? Capital inflows slowed. Interest rates on new borrowing rose sharply. The government was forced to refinance old debt at ever more punishing terms. Every bond issue bought time, but at a higher price. Confidence, once the foundation of the system, became its greatest vulnerability. And confidence, unlike money, can vanish overnight. The final descent began when fear replaced hope. As rumors spread about a possible devaluation or default, Argentines did what any rational saver would do. They rushed to the banks to withdraw their money. But the banking system, tied tightly to government debt and foreign obligations, could not survive a full-scale run. In a desperate attempt to stop the bleeding, the government imposed the infamous corralito, limiting cash withdrawals and freezing deposits. Overnight, millions of citizens discovered that their money was no longer truly theirs. Trust, already fragile, shattered completely. What followed was not just an economic crisis, but a social explosion. Protests erupted across the country. Pots and pans rang in the streets as symbols of hunger and rage. Supermarkets were looted. Police clashed with demonstrators. In a matter of weeks, Argentina cycled through multiple presidents, each inheriting a situation already beyond control. The state defaulted on its sovereign debt, the largest default the world had ever seen at that time. The peso was finally allowed to float, and it collapsed, losing the majority of its value in a short span. Savings denominated in pesos were wiped out. Dollar deposits were forcibly converted at unfavorable rates. The middle class, once proud and stable, was pushed abruptly toward poverty. The human cost was staggering. Poverty engulfed more than half the population. Unemployment soared. Professionals drove taxis. Families relied on soup kitchens. Immigration surged as Argentines sought opportunity abroad. The psychological damage ran deep. The collapse was not perceived as a natural disaster, but as a betrayal. People had trusted the rules, the institutions, the experts, and the system had failed them anyway. In the aftermath, Argentina tried to rebuild, but the scars shaped every decision. The government distanced itself from international financial institutions, blaming them for promoting policies that prioritized currency stability over social resilience. Legal battles with creditors dragged on for years. Growth eventually returned, aided by a cheaper currency and a global commodity boom, but the memory of collapse never faded. The peso was no longer sacred. Dollars were hoarded under mattresses. Trust in banks remained weak. The crisis became a national trauma, passed down as a warning. What makes Argentina's story so unsettling is not that mistakes were made, but that many of those mistakes were once praised. Fixed exchange rates, fiscal discipline, open capital markets, and investor confidence were all considered hallmarks of sound policy. Yet when combined without flexibility or safeguards, they created a system that could not bend without breaking. The same forces that stabilized Argentina in the beginning amplified its collapse in the end. And this is where the story stops being historical and starts becoming uncomfortable. Because the patterns that destroyed Argentina have not disappeared. Pegged or semi-pegged currencies still exist. Governments still borrow in foreign currencies they cannot control. Austerity is still prescribed during recessions. Capital still flows in during booms and vanishes during fear. The language has evolved. The instruments have become more complex, but the underlying dynamics remain eerily familiar. In recent decades, nations across the world have faced versions of this dilemma. How to maintain credibility without sacrificing flexibility. how to attract capital without becoming dependent on it, how to stabilize prices without strangling growth. Time and again, the promise of stability has come with hidden fragility. When conditions are good, the system looks unbreakable. When conditions change, it can collapse with shocking speed. The Argentine collapse teaches 3 lessons that remain painfully relevant. First, monetary stability without adaptability is an illusion. A currency that cannot adjust to economic reality will eventually force adjustment elsewhere, through unemployment, debt, and social unrest. Second, debt is not just a financial tool, but a political trap. Borrowing can delay hard choices, but it also narrows future options, especially when confidence turns. And third, trust is the most valuable and most fragile asset in any economy. Once citizens believe the rules can change overnight, rebuilding faith can take generations. Argentina's crisis was not inevitable, but it was the logical outcome of a system that valued appearance over resilience. It reminds us that economic models are not laws of nature. They are choices, shaped by incentives, power, and belief. When those choices ignore human behavior and political reality, even the most elegant systems can unravel. The haunting question is not whether Argentina could happen again, but where. Somewhere, right now, a nation may be celebrating stability built on rigid promises, rising debt, and borrowed confidence. Somewhere, the warning signs may be dismissed as temporary noise. And somewhere, people may believe that because the numbers look good today, tomorrow is guaranteed. History suggests otherwise. If this story made you question what stability really means, and how fragile modern financial systems can be beneath their polished surfaces, consider subscribing to the channel. Here, we don't just retell economic disasters, we dissect them, connect them, and ask what they reveal about the world we are still living in. Because the past is not over, it's rehearsing,